So hello everyone and welcome to this Building Bridges webinar on sustainable finance trends to watch this fall. My name is Kaylee Taylor and I'm the coordinator of Building Bridges Week, and we are thrilled to be joined today by our incredible panel of experts. Today we are joined by Elodie Feller, who is the global policy lead for the UNEP Finance Initiative, or UNEP FI as you may know it. Alex Bernhardt, the global head of sustainability research at BNP Paribas Asset Management, and Vincent Kaufmann, the CEO of the Ethos Foundation. So thank you, speakers, so much for being here. I'm going to come back to you right after I go into the trends, but you are free to turn your camera off now for the moment. This webinar is the first webinar in our series where we will be covering a number of important and timely finance topics every second Thursday of September as we prepare for the main event, which of course is Building Bridges, that will take place at the beginning of October. If you haven't done so already, please do make sure to sign up for the next webinars. The webinar on September 15th is going to be looking at social issues and how we put the S in ESG. And we're also going to be zooming in on the energy transition at the end of September, on September 29th. So please make sure to sign up for those. These topics and many, many more will be covered during Building Bridges, which is just over 1 month away, running October 3rd to 6th here in Geneva. We have an absolutely incredible program lined up for you with a high-level summit, 68 crowdsourced events, a networking village, a pitch stage, and much, much more. You can use that QR code that you see right there on the screen to get more information and to secure your spot at the event. Now, without further ado, let's get into the webinar. The vast majority of this webinar, after I give my introduction, is going to be an open discussion with our panelists. So I did want to point out that on the side, you're going to see a Q&A box. That's on the right-hand side there. You can use this to ask any questions you may have for our panelists. And, this will allow them to answer your questions directly and to weigh in on the things that you find are the most important. But before I bring them out for that, I wanted to give you a very quick primer on the trends that are on our radar here at Building Bridges. I thought a good place to start would be with the big themes that we're going to be at the event itself. So as you know, Building Bridges is a crowdsourced event, so these themes do provide a glimpse into what is most pertinent in the community right now. I'm not going to go into these in depth, as you can find them on our website and in the program, but I am going to zoom in on 6 big trends that we're following the most closely right now. First up is putting net zero into action. We're now almost 1 year post COP26, where we saw the institutionalization of the Glasgow Finance Alliance for Net Zero, or GFANZ, as you've probably heard it called. Since that time, over 400 financial institutions and 1,200 companies have made net zero pledges. And while this level of commitment is extremely impressive, it's also a pretty daunting challenge for implementation. There's a lot of skepticism out there because with climate, as we all know and we've all seen for the past several decades, there's often a lot of talk and not a lot of action. But now extreme weather events are a constant reminder that we can no longer wait and that action is no longer optional. It's still to be seen how the GFANs are progressing. They just published their first draft framework, but at the next COP in Sharm el-Sheikh this November, we're going to be following that very closely and hearing what the community has to say about how they are implementing these ambitious promises. The next trend we're following is the looming food and energy crisis caused by the war in Ukraine, and the impacts that this is going to have on the finance industry's sustainability strategies. When Russia first invaded Ukraine this past February, discussions immediately arose about what it's going to mean for food and systems. Both Russia and Ukraine are huge exporters of food worldwide, and Russia energy accounts for 17% of all global natural gas, as well as 12% of all global oil output. Energy shortages are expected across Europe all winter, and severe famine, particularly in Africa, is foreseen as well. From a pure macroeconomic perspective, the war has caused increased inflation and more volatility while simultaneously slowing global growth. But from a sustainability perspective, there are a number of implications as well. With fossil fuel energy prices skyrocketing, the finance industry's sustainability values are being challenged. Linked to our last trend on net zero, these types of commitments are impossible to reach without increased investment in fossil fuels. So we will be watching if investors stay true to their values and to their commitments, or if they ride these market waves. Another trend that I'm not even sure I can call a trend anymore because it's been around for so long is Taxo Mania, as we call it, which is the rise and the development of a range of taxonomies, naming standards, and guidelines for regulators in countries all over the world that prevent greenwashing, assure asset owners that their money is doing what they think it is doing on a sustainability front. The EU recently adopted its taxonomy and decided to include nuclear and natural gas, which caused quite a lot of controversy. Discussions continue in a variety of forums, including the ISSB and the G7, on how we can create baseline interoperability standards between these vast number of regulations that are coming into effect, and we'll be tracking where that discussion leads in the coming months. We're also watching the evolution of ESG, and this particular trend takes a number of different forms. ESG is facing pressure from both sides. On one hand, you have increased skepticism around greenwashing and regulators clamping down and tightening up definitions and practices. But on the other hand, there are right-wing movements that are completely rejecting ESG and calling it woke capitalism. The finance industry is also rethinking its practices, with many asking data providers for more transparency in ESG scoring to enable a more nuanced view of how companies are performing on a wide range of criteria and not just a single score. Or asset managers themselves are making their screening decisions more transparent and open. While nothing is definitive yet, we are certainly following this next phase of ESG. Next, we are looking into sustainable debt. In 2021, sustainable debt from corporates and sovereigns hit an all-time high of 120 trillion, only for sales to drop to a 19-month low this summer. While it's of course normal to see slowing sales over the summer, there are some additional factors, including, again, concerns over greenwashing, as well as eroding premiums due to the high uptake of these types of products. As bonds are generally popular in bearish markets, we'll be tracking how sustainable bonds perform in the coming months. And finally, we are noticing more and more scrutiny on passive investment strategies. Passive in choppy markets, and therefore its popularity has increased. However, for investors in public markets, exercising shareholder rights and employing engagement strategies are virtually the only levers available for having sustainability impact. ESG metrics used to create passive strategies vary greatly in how they score different companies and are completely backward-looking, whereas active analysis and ownership creates a vested interest in companies' performance on financial and sustainability metrics. We are curious if passive strategies will continue to grow or if active ownership will remain fundamental. So with that, now let's turn to our panelists to kick us off with a two-part question. So first of all, Elodie, and this is going to be the same question for everyone. So Elodie, are there any trends missing from the Building Bridges list that you're noticing in the market right now? And which trends do you feel are the most pertinent at the moment?
Thanks, Kelly, and thank you for having me in this webinar. I think your list was pretty comprehensive, so I might just complement some of those points you've made already. Indeed, the race to zero is growing in the lead up to the COP, and we do need to improve the accountability mechanisms of those voluntary pledges. And so, what you're going to see in the next quarter is the recommendations from the Secretary General's high-level expert group that is going to look into those net zero emission commitments of non-state entities, and that means recommendations for how the sector, but also how regulators might improve this. Second, indeed, there is greenwashing making the news, but also we see financial regulation picking up, and particularly on transparency. In Europe, we're soon to see a tremendous amount of data coming from the companies, but also from banks and investors. It's not going to be amazing data to begin with, but I think we're going to start seeing some interesting disclosures. Still on financial regulation, I think we also have central banks getting involved pretty seriously as part of their financial stability mandates. And progressively, you see that they're introducing climate stress tests, and we see the results coming through, not necessarily in the next quarter, but they've started coming through this year. Taxo Mania, that's an interesting word. Yes, I think part of the taxonomy development, what you see is not just climate, but also more environmental objectives that are going to come through the EU taxonomy. Was supposed to be for the end of this year, it's likely more to be for next year. But indeed, what we want to see is a discussion moving beyond climate. And at the end of this year, you have the Convention on Biological Diversity, and the financial sector should and will engage. And last, I think complementary to the taxonomies, we also see transition plans making their way into financial and corporate legislation, not just in the EU, in the UK, in Japan, across the OECD. Everyone is most focused on refining their framework for transition finance. So I think these are interesting stuff also to see coming in the next quarter.
Perfect. Thank you so much, Elodie, for that. Alex, over to you.
Yeah, I think your list was fairly comprehensive. The only thing that I would mention, which really cuts across some of the trends that you listed, is the move towards impact. If we zoom out a bit and look at the evolution of sustainable finance over the last 20, 30 plus years, we started really with SRI, or socially responsible investing, which had a sort of activist agenda. We've moved more now towards ESG, which is arguably very mainstream at this point, with $100 trillion and more of investors now having signed up to the UNEP FI and committed at the highest levels of their organization to ESG integration. And so what's happening now, as you see in your evolution of ESG slide, there's a lot of criticism, some of which is definitely warranted, of the overall approach to ESG investing. And I think the logical next step in the evolution of the industry is to move now more towards impact. We're seeing in surveys of consumers that what they actually want from ESG investment strategies is impact. And we're also recognizing that we need to have really strong conversations within the sustainable finance community about the impact components of intentionality and additionality, and try to understand a bit better what our role is as a broader community in driving change in the real economy. And these are super difficult but exciting conversations for us to be having right now. And I'm really looking forward to this sort of next phase in the development of sustainable finance, which is really going to focus more on impact in my view.
I have to say that even in between 2 years of building bridges, I noticed the events that we had put forward were more focused on impact. So we're definitely seeing that even in our own realm, and I think it's an excellent point to pick up on. Vincent, over to you. What stood out for you? Did I miss anything? What's most pertinent to you at the moment?
No, I think you covered the most salient topic, actually. One thing for which I had some worries this year, we saw over the past year more engagement, as you said, and we will come back on it. I think it's also connected to increase of passive investment, more engagement and more shareholder active ownership strategies. We still saw last spring a step back in supporting climate-friendly shareholder resolution, for instance. So we had a very positive trend over the past years, and this year we saw a step back. So that's where I'm a little bit worrying. I think it's also connected to the very large and the consolidation in the market toward 3 very big players in the passive ownership strategy, the big 3, and they play a key role now in terms of how shareholders are engaging and how they can influence companies. So this consolidation of the market is a trend which has potential risk on our active ownership strategies, somehow too big to vote or too big to influence. So that's a trend that I'm looking at. Otherwise, I think this question of impact has also to do with a double materiality analysis. I think and it's good that we're moving from just analyzing ESG on a risk management perspective and how a company is managing its ESG risk. And we need as investors to look at both sides of the coin, and also what is the real impact of the company on the environment and on the social. And that's how we will also reduce, I think, this accusation or misunderstanding with the sustainable finance world. This accusation of greenwashing are fair, because we're looking only to one coin, to one face of the coin. So it's good, I think, to move toward this impact and double materiality aspect.
Great. Thank you so much, all panelists, for those very helpful insights. Elodie, on the policy front, many have felt that the EU's inclusion of natural gas and nuclear in the taxonomy hurt its credibility. What's your take on this? Is the framework still helpful? Do you anticipate this controversy may have implications for the development of the other parts of the taxonomy, the social taxonomy that you mentioned previously?
Thanks, Kaylee. It's definitely easier to respond to this question now that it's actually adopted. I think the taxonomy remains a huge milestone for sustainable finance. There's no way out of the EU taxonomy. It's not so much a matter of which sector you add in and which sector you take out. I think there's been quite a clear voice from the environmentalists and scientists that nuclear energy, and in particular fossil gas, was not necessarily in line with the objectives of the framework. There's also another comment that the Commission should have waited for the development of the amber category of the taxonomy, so the transition criteria, to make sure that we keep this clear methodological framework and we avoid mixing transition with substantial contribution. I probably agree with this view that it could have been better explored. But I think irrespective, and the reason why the EU taxonomy is there to stay, is that investors and banks have shown time and time again they understand the science and they want to support the transition to a net zero future. And investors will continue to be able to make their decisions. They will not even have to report on their gas and nuclear exposures. It's a voluntary KPI in the Article 8 delegated act. So it's a tick the box exercise when it comes to gas and nuclear. Probably because indeed the politics that came to add gas and nuclear felt the investors would disagree with this in the first place. I think what it says is that politics will likely continue to get in the way of how taxonomies get formed, especially when taxonomies enter the policy and the regulatory sphere, which is when they start becoming mandatory for disclosure or for other purposes. There's politics getting involved. Wait for the agriculture taxonomy. There's going to be a lot to be seen, and gas and nuclear will become very, very much in a past incident. I think that the focus should be on making this framework work as it is. We have 100 economic activities in the EU taxonomy just as of now on climate. And we need to make it usable for the industry. We need to make sure they can actually meet their reporting obligations. So we need to make sure they understand the treatment of social issues. They have to start reporting on alignment 1st of January. For the minimum social safeguard, it's not a done deal. And they need more guidance. So when I say they, it's the entire EU market, right? So all big corporates, all investors for their funds, all banks and insurance companies. And we need to give them more guidance to make sure they report credible alignment KPIs. So I think usability is very much where the real credibility issue is, less than whether we agree on which sector or not. And last but not least, you have more than 20 jurisdictions that are developing or have adopted their own taxonomy. You showed it on your slides. And each region, each jurisdiction is having its own debate about which sector they want to include and on what basis. So I think we need to be realistic that the moment you bring a framework into a political process, there is a political process involved. And it doesn't mean that all decisions are necessarily going to be wrong. And we do have some good basis and good baseline to start and to build from.
Great. Thanks, Elodie. Yeah, we can't let perfect be the enemy of the good here. We need to move ahead. Alex or Vincent, if you'd like to add anything, you're most welcome. Or I'm happy to move on to the next question.
Maybe just from my side, Elodie, very good at politician aspect and making. No, but I think still we moved from a scientific and a very good document, which was scientist-based. A high expert group really had a clear view, made a tremendous work to define those sectors, to set clear KPI, at what stage, and those guidelines are very important to define what is. So it's a very good basis. Introducing, of course, those two sectors diminish the scientific aspect towards political. So we were a little bit disappointing. It's a wrong message. However, it remains a basis for companies to disclose their green revenues. It will be very important also for the SFDR. And this is something when we engage dialogue with companies, we always they self-declare they have green revenues nowadays with their own methodology. So we definitely need some clear standard to define what can be reported as green revenue. So that's a little bit still disappointing, because that won't help the cause to introduce to these two sectors. But on the other one, I think we have clear definition. So it stays helpful to avoid greenwashing from companies and self-declaring non-green revenues, but a little bit less with these two sectors, of course.
I think that putting the political aspect of this aside, which I understand the dynamics there, looking practically at the technical screening criteria as they're described for, say, for natural gas, what our analysis shows is that there are very, very few companies or activities that are going to actually qualify as aligned with the EU taxonomy once the technical screening criteria are applied. So I'm not sure that while it was added in name and the criteria now exists to the taxonomy, it's realistically, moving from eligible to aligned is going to be pretty hard for a lot of companies in those sectors. And so, for us, it's something of a non-event in that sense. If you look at it practically from an actual data measurement and alignment perspective. But yeah, I would also underscore to what you said, Elodie, is that as a sustainable finance practitioner, having more disclosure and more data that we can action around the EU taxonomy is going to be essential. That's going to happen organically with the implementation of CSRD and all the corporate reporting requirements. But yeah, in the meantime, we're operating in a sort of an interim period or a liminal sort of stage of the market's development, and there's a lot of confusion and discussion that needs to take place around what kinds of EU taxonomy data are permissible. There's a lot of discussion around estimates, whether they're allowed or not, and what constitutes an estimate and things of that nature. And so I'm looking forward to some more guidance from the regulators. I think we were expecting some in the summer. Summer's pretty much almost over. I guess the 21st of September is the technical end of summer, so maybe we can wait until then. But anyway, lot to be seen on that.
Great. Thanks so much, all of you. And Alex, I'm going to continue with you on the next question. I went on BNP Paribas kind of trends page, and I saw that the latest one said, there's a lot of volatility in the market. Do you think this volatility and inflation and fear of recession will hamper sustainable investment strategies, which, prior to now have been growing year over year?
I would say the short answer is no, but there's a much longer answer to that. Number one is that I think that one of the most durable trends, if not the most durable trend in the market right now, is the move towards sustainability in finance. Certainly that's the case in Europe. Maybe less so in other jurisdictions, but it's coming along and in those areas as well. And so it would take a lot to overcome that trend that existed pre-pandemic and through the pandemic and now and even persists now. And so through the Ukraine war and other elements of volatility. So it remains to be seen, but I think that trend in and of itself has a lot of staying power. And then there's another component too, which is that if you look at the issues that are being caused in the marketplace by, say, the conflict in Ukraine, there's a sort of a triumvirate of issues that are called into question by that, and all the supply constraints in the food and energy markets, which you already mentioned. It's driving faster inflation. It's implicating energy security concerns, and as in some jurisdictions we're switching back to coal to replace natural gas supplies lost, it's implicating climate concerns. And so you have this triumvirate of issues the best solution to address that triumvirate of issues is further investment in the low carbon technologies. Absolutely. And that's true sort of certainly in the medium and long term, and possibly also in the short term. And this is, I think, part of the reason why we saw enough momentum in the US, for instance, to pass the Inflation Reduction Act, is because, and why a huge portion of that act was related to clean technologies and incentivizing further investment there, is because it helps to address all three of those issues. Renewables tend to be deflationary. They don't have, initially there's an upfront capital cost, of course, which could cause some short-term inflationary issues, which I'm happy to talk about more, but over the long term, certainly they're very, very deflationary because they don't require fossil fuel input costs. They, of course, help to address domestic security, because you're energy security, that is, because you're producing the renewable energy typically based on your own renewable resources, and then it also, of course, addresses climate action. So if you can solve three political aims at once, then that's a win-win-win. But beyond the politics too, I think it also has implications for investors in that as more incentives go into these low carbon or clean tech industries, there's a lot more investable opportunities there, and it means that we need to be thinking more collectively as investors how we're going to target that opportunity set.
Mm-hmm. Great, thank you so much, Vincent. You kind of already started to address this, but last year Bloomberg predicted that passive investment strategies would overtake active strategies by 2026, and that bear markets would only accelerate this trend. Is this consistent with what you're seeing? What are the implications of this, given that engagement and activation of shareholder rights are core strategies for implementing sustainability in public markets?
I think the trend is continuing, and yeah, it has to do with this consolidation of the market. I was referring to the big three. It was BlackRock, Vanguard, State Street. So they manage the specialty are replicating those markets. So I can see the point of asset owners who have paid managers a lot of management fees or not delivering any alpha. So I can see from the perspective of an asset owner, why should I take this extra cost and underperforming the market? Of course, it's not all of them, but of course, the consultant play a big role. They don't want to take risks, so they just copy the market. And for a pension fund, you have a board of trustees. You have to imagine that those people are not really knowledgeable. At least in Switzerland, they still not that knowledgeable in finance. So they have a fiduciary duty. They are taken in two directions. Shall I take the risk of avoiding certain sectors and things like this, and then being potentially in breach with my fiduciary duties of paying those retirement? So I can understand this, and that's so. My understanding and my view is that it will keep on increasing. Those passive investment strategy. I guess the replication of sustainable index will take also much more in the future. I think this is something we will see. It's pushed also by the EU regulation. So replicating sustainable index or low carbon index. So this will continue. So it's not because you're a passive investor that you cannot be an active shareholder, and that's all about active ownership. And I guess there is this debate excluding, engaging. Of course, I believe and I see that if all shareholders push the board of directors toward a direction, they have to listen to their owners and will align the capex with the transition. So being an active owner can really bear fruit, but we have as shareholder to work together, and that's typically the case with Climate Action 100 Plus, which is the largest engagement initiative on climate, targeting the 167 largest CO2 emitters that all investors almost have in their portfolio because they are so big. Or not all, of course, some have already excluded coal, but most investors have those companies in their portfolio. And speaking there in one voice, and starting also to activate our shareholder rights, opposing board members when they are not aligned, and intensifying our measures is certainly something which will push change. And that's also why the Republicans are saying, no, climate action is a coalition. They form a group. They fear actually the weight of those investors being able now to influence companies, align capex, and those kind of things. So I'm confident that we need to go in that direction. That can have impact. It's too easy to sell off a company and just avoid the CO2 emission, decarbonizing your portfolio and not the real economy, blah blah. But it's true. I mean, if you sell a coal mine to a private equity companies, what influence you will have? So I think we have to stick to those companies. At one point, if we are always in the minority as shareholders, I think, and I tell the pension fund, one point, if you are the only shareholders to want the board to go in one direction and you're always in the minority, then yeah, okay, sell the stock. But first try and join force and activate your rights.
Great, thank you. Alex or Elodie, any thoughts on that?
I mean, first, I'd say that I think that we've always been operating in the industry under something of a misnomer. I think that we call it passive investment is inaccurate, right? I mean, that is everything from the selection of which index to track, and whether to use a synthetic replication versus an actual replication or a statistical sampling method for tracking that index. Those are all active decisions. And as Vincent mentioned, there are a number of indices coming to market that already exist that are tracking ESG scores or that are looking to target impact, but some of them are highly concentrated and look a lot more in practice like active strategies than passive strategies. So we're seeing, there was a few years ago, there was a lot of discussion about smart beta. Maybe that conversation is still going on. I'm just not fully aware of it. So there's a lot of blurring of the lines happening. And so that's something to keep in mind as well as the market evolves. But whether or not, passive strategies will, so I think whether they increase in volume and overtake active is in part dependent upon how we define passive. But also I do think that in bear markets, there are sometimes, and there's different evidence on this and depending on how you slice and dice the data, but sometimes active strategies can outperform in bear markets and offer the opportunity to minimize downside capture. And I think the same may be true for sustainable strategies as well. So, I mean, it remains to be seen how that will all play out. But I otherwise agree with everything you said, Vincent.
Anything to add?
No, not much. All I can say is from the regulator standpoint, in the Commission and its strategy did not take this into account as a market infrastructure issue. So it's true that that might be something for the regulators to start looking into. I think the concentration issue that the Commission is going to look at is this ESG rating agencies consolidation market. So, but not on the active versus passive and how the benchmarks, are playing a more and more important role. I think second, and that's more about shareholder rights directive more than the consolidation of the market itself, or the move to the passive industry strategies. But we do see a need in the shareholder rights directive in the EU for an upgrade to include the sustainability components of active ownership from a legislative standpoint. And I think Alex mentioned double materiality, and Vincent as well. That's an important part of the puzzle that is missing in the legislative framework in the EU right now. So something to look for in the coming few months, at least when the directive gets into the revision process.
Mm-hmm. Great, thanks. I think I'm going to turn to the audience for a second. We had Emmy Mima ask, do you think that passive investment will increase also as a result of better sustainability data available to investors? Which is, I think, kind of exactly what Alex just was beginning to address there, in terms of as these indices become more sophisticated and this sort of thing. But is there anything you'd like to add to answer Emmy's question there, Alex?
No, I don't think I think the question contains the answer in a sense, right? As more data does become available on sort of the SDG alignment of specific companies or the EU taxonomy alignment of specific companies, the index providers and other data providers and asset managers will figure out how to productize that information, and it's definitely going to create a rush in say the ETF market for new products which are aligned with say impact related themes or other ESG related themes. And so yeah, I think we will need to parse in our assessments of the growth of the passive market, whether it's pure passive like S&P 500 say tracking strategies, or if it's more modified specific products. And another thing to mention, I think, is that there will be some of this is definitely challenging, I think, from how shareholder activism and engagement takes place in a passive market context definitely does require more scrutiny, I think, from regulators. But overall, the pressure from passive side of the market onto the active side of the market is resulting in some fee declines. There's a lot of competition, and competition is generally good in a marketplace. And so I think there's some positives to this evolution that we should also look at and try not to differentiate from or what's the word I'm looking for? Discourage. But also, there are things that you can achieve in active management from a sustainability perspective right now that you can't in a passive or index context because of the lack of data. And so that's something to keep in mind as time goes on. Data quality will improve, but we're a long way from full transparency of full disclosure of ESG related information that's been audited and that is standardized across jurisdictions. And so there's going to be a role for active management here for a long time, in my view.
Yeah, I would echo that. I think more data we will have, and reliable data from companies, the more we can integrate those data in our investment decision. And therefore, I think will rather help having those data actively managed strategy, demonstrating the impact, having some good data. Nowadays, I think ESG ratings are still focusing a lot of transparency, policy assessment. With a lack of data, it's still difficult to assess the sustainable performance of a company or its impact because the green share revenue and so on. So we're still really making the checklist and lacking a little bit on measuring the performance, as we do with financial analysis, because we have financial statement with auditing, with standard, and we can calculate it, a return on equity for all companies and EBITDA margin and so on. If you want to compare the lost time injury rate of a company X with a company Epsilon, then you have issues because maybe the company does not publish, you don't have the real trend, you're not sure the data are audited. So the more reliable, sustainable data we will have, I think the more we can really integrate that into active managed strategy. So the other way around, I think.
So we don't want to lose the taxonomy just yet, Vincent.
I say there is a good thing because now we have a good framework to measure that. If you take just nuclear and do not harm principle, if you include the nuclear, and how can you then justify the do not harm principle with something else? Anyway, that's my view.
So I'm gonna spare Alex from this question because it's very Swiss. And I'm going to start with Vincent. Elodie, I'm not sure if you've covered this at all either, but there's a question about what are the views on the recent launch of the Swiss climate scores. So Vincent, any thought on that?
It's a Swiss step. So it's a self-regulatory. It lacks a lot of information behind, but it's a beginning. So I think it's good. It will set a standard. It will push. It's a pragmatic way. It's the Swiss way to go. It will push funds, asset owners, and to think about those KPI to be published. Too much focus still on the intensity or CO2 intensity, carbon footprint of portfolio. I think it's still too much backward looking. There is a possibility to disclose the temperature of portfolio. It's still an optional way. I think it's still new methodologies that have to be developed. There is some question mark typically on the active stewardship part. We put the comment in the consultation, which we are not taking into account. Typically, the Swiss code, you have to disclose the percentage of climate resolution you support at the general meeting. big question. Typically, if you have a say on climate from a company, so if you have to vote, typically UBS submitted this year its climate plan and its net zero ambition. So as shareholders, if you vote for this, because of course we want UBS to be net zero. So if you vote for this resolution, board resolution, then is it good or not? We actually recommended to oppose because we believe not all activities are covered by the CO2 reduction target. So we believe we should have opposed this resolution. So it's still very undefined what should be considered as a positive vote or not positive vote on the environment. So we still have to see the implementation, and I guess there will be further explanation on how to answer those questions. So a first step, not a revolution in my view. But something we already have some members pension fund who are happy because they have a framework now to report on. So we're working with them now to help them to report on their Swiss climate score. So I think it will bring further transparency.
Right. Elodie, anything to add?
I don't know the piece of legislation well enough. So, but I can say that it sounds like very useful in light of the net zero alliances and in supporting the asset owners and banks and insurers meet their voluntary commitments. At least that brings framework, I think, to the target setting, the scenario analysis, all the protocols that go behind it. So it seems like a positive development indeed.
Great, thank you. So as I mentioned in kind of looking at the trends, ESG is a little bit in the hot seat on multiple fronts recently. And I think Alex brought up very well that there's also this look at how we move more to the impact. So this is a bit of an open question, but where do you see ESG going from here? What do you think is needed to move from that kind of ESG focus into impact, or is there a way we can improve on ESG? We've talked a little bit about data. I leave this a little bit open for each of you to kind of say where you think this space is going, and maybe I'll go, since I skipped to Alex on the audience question, I'll maybe start with you there.
Sure. Well, I think that there's a lot of activity already taking place, which is serving to address this concern. For instance, if we look at the effort to, this may be the wrong word used, but to recategorize funds per their article status in the EU under the SFDR regulation. I think that making sure that fund managers are clearly articulating why a fund is Article 8 versus Article 9, and what are the factors that are taken into account in the fund process that constitute its classification in one of those articles. That kind of interaction is going to become increasingly important as we move into the next phase of the evolution of the market, and that's, in that case, it's regulatorily driven transparency, which is driving the improvement in understanding of what each strategy does in the marketplace. We're going to see more regulation like that. The SEC has already proposed some rules which have a lot of similarities to what's happening under SFDR in the EU, and I expect other markets will move in the same direction. And so, for me, we're already on the path towards improving transparency and combating greenwashing through a lot of this regulatory interaction. But for us at BNP PAM, it's very important for us to be as transparent and as open with our clients as possible, and to embed as thoughtful of a process into our ESG integration and impact orientation as possible and practicable, considering the landscape. So I think transparency really is the antidote in sum to a lot of the concerns being expressed around ESG right now.
Great, thanks, Alex. Elodie?
Thanks. And I can just only build on what Alex said. I think it makes a lot of sense. I think when we talk about ESG integration, to me, it sounds like we're talking about a risk metric, no? And so this is not going anywhere. It's just like any other risk management metric. It must be factored into the financial decision-making process. And I think this is even so true that it's been clarified, written black on white in any financial services legislation in the EU, from prudential to UCITS to occupational pension funds and so on and so forth. So the ESG, sort of the outside-in part is there to stay. I think where we're having greenwashing claims and so greenwashing issues coming out is on this inside out, right? So the impact side of funds that claim some green components or green objectives. And this is where we need to be a bit more specific in terms of what type of greenwashing we're talking about, because that can be actually very difficult to supervise or even to regulate. Bringing transparency is not good enough, because you still need to put a baseline or explain, what is good enough. Otherwise, can you decide that something is green or not? So it's quite a complicated matter. And when you talk about greenwashing, usually you want to talk about financial products and services with a marketing claim or a sale claim attached to it. And this is what regulators are used to looking into. And it's quite easy. You say, oh, I claim my fund is green, so it's Article 8, and you start from the marketing claim, basically. But now what we start seeing with those net zero pledges is that it's even going all the way to company level commitments now, where they say, oh, I'm going to claim my net zero policy, and the public says, oh, but you're never going to be following through, or it's not substantiated. And legally speaking, that's very difficult to analyze, and hence we need to clarify this better. So clarify the terms, I think, around greenwashing. We need to improve voluntary accountability mechanism. So you have this self mechanism within the industry to make sure that they bring the same transparency that they claim they want to bring to market in the first place. And then agreed again with Alex on we need to improve the sustainable finance legislation. There are lots of weaknesses in the SFDR that we know of. We need to be able to fix them. We need to be supportive to fix them. We need to, I think Eurosif produced a very good paper in this regard in June. We need to support frameworks such as taxonomy frameworks that bring you that level of performance, that level of baseline, the do no significant harm baseline. And that it's only with such baselines that you can actually produce labels that are credible and that can be supervised or verified by third parties and so on and so forth. So yes, self-market voluntary improvement of their own accountability mechanisms, and also we need to improve sustainable finance legislation.
Great, thanks. Vincent, how do you see this evolution?
I think first of all, the EU legislation with SFDR force us. We have also Ethos Label Fund, also with a French asset manager, Clarton. Where we really need now to define the objectives and the target of the fund within the fund contract, and it push a lot of question with the asset manager. And typically we have this discussion. If we set this goal in our fund, means that in your financial research, you will have to take it into consideration seriously nowadays, and makes a big change, I think, just to define the goals, the KPI, and how you want to follow it. And then you have to go back to the companies where you want to invest in, because most of them, it's difficult still to have the relevant data. So nowadays, without any framework, of course, there is a big expectation gap from civil society who have big expectation, which is a climate crisis. We think and having a big asset manager claiming to be green and being invested in Exxon, of course, that will push suspicion on greenwashing. So it's necessary to have those kind of regulations, set clear target, and it's very helpful. But with our Swiss perspective, of course, it's more on the self-regulatory basis. So, but FINMA, the financial authority, is also looking now at the fund contract of fund, and I think we're also moving there. We're starting from far, and that's normal that there is some greenwashing claims or accusation from civil society because the expectation gap is growing.
Mm-hmm. I'm going to take a few questions from the audience, but there's quite a few right now, so I'm going to assign them so that we can move through. So I'll start with Elodie. Do you have any insights on what can be expected on the S covered in the taxonomy, the social side?
Mm-hmm. So thanks. The process answer to that is the Platform on Sustainable Finance issued its report in March, so issuing criteria and a framework for social taxonomy, and this report has been handed over to the European Commission. And the European Commission needs to decide what to do with those criteria and when and if at all they want to develop a social taxonomy, and so legislative text for a social taxonomy. I think this is not coming anytime soon, or at least not as soon as some would like. The major focus is going to be on the other 4 environmental objectives, so to really finalize the green taxonomy. And I think there's still a lot of, on the social aspect as well, what the priority will not be the social taxonomy necessarily, but the social safeguards. So how to understand the minimum baseline on social issues. So that's the safeguards in the do no significant harm criteria, for example, that everyone is going to have to report against in 3 months. And that's already a huge endeavor. And the substantial contribution, there's still a lot of issues to be resolved, not just technically and so not just at the level of the criteria and the method, but also you can imagine the political elements of coming up with a social taxonomy is going to take some time. So I think the flag is rather yellow or orange. I don't know. It's on a wait and see mode. There is nothing that says it's not going to happen, but it's not going to be prioritized.
And what were the sorry to put you on the spot, but what are the 4 other environmental objectives?
Thank you. So the taxonomy, the EU taxonomy, focuses on 6 environmental objectives. The first is climate change mitigation. Second is adaptation. These 2 have been produced through a delegated act already. And the other 4 coming are going to be around circular economy, water, so oceans, marine resources, biodiversity and ecosystems, and pollution of soil, air, and water. And so these are the other criteria for which the Platform on Sustainable Finance has issued criteria, and the Commission is transforming them into legislation as we speak.
Great, thanks, Elodie. Alex, I'm going to give you a bit of a tough one, and I'm going to interpret it a little bit. The question is, what are plans for organizations in emerging nations in Africa? But maybe the way this a little bit differently is, with the market that we're entering, a lot of volatility, we are expecting large famine issues in Africa. How are you assessing work in emerging markets? How can we drive more finance to where it's needed most in emerging markets? Do you have any thoughts on how we're building an equitable financial system as well?
Yeah, that's a meaty one for the end of an hour webinar. But I will say that we recognize in our research around the Sustainable Development Goals, for instance, that if you want to be a serious investor in impact, that a huge portion of the SDGs are going to be met or not in emerging markets. For instance, many of the SDGs related to access of basic services aren't issues in OECD economies. They just aren't. We have 100% electricity and water and sanitation access in most of those places. So most of those SDGs will need to be tackled in emerging markets. The issue is well understood. I think that there's a need to innovate and develop new products that focus more on emerging markets. And we just recently launched a emerging market climate solutions fund ourselves. So that there's a lot to be done in that space. Let's see. I think that there's also a distinction to be made between investing in public markets versus private markets. The opportunity set for building, say, new infrastructure in emerging markets that can help to address issues like energy access or food access. Much of that is going to exist in private markets. I think there's a need for more blending of capital with public and private sources to ensure that those types of investments are either de-risked or otherwise incentivized. And a lot more collaboration with the public and private will be needed in order to scale up the capital to the level that is really required to meet the SDGs. And so we're excited to have more conversations about some partnerships like that with entities in the public sector, and are exploring different avenues now actively. But there's a lot that needs to be done to make sure that finance and capital flows better align with the SDGs. And I wish that I could say that it would be solved in the next few months and could address the impending issue. I don't think it will be, but longer term, absolutely, we need to have more of this investing for impact in emerging markets. I mean, being what this is.
I don't think you could have done a better plug for Building Bridges, which is all about how we build those connections between these different types of actors and how
I'll expect my commission later.
Yeah, exactly. how we create this space where the different actors can work together to bring what they have to the table so we can move finance to where it's needed most. I think this might be last full question. So there's a couple that are kind of similar on here, Vincent, around measuring impact. So I'm going to read you this one. Moving towards impact, what are your thoughts on the possibility of standardizing the measurement of impact? Is it possible, including scope 1, 2, and 3 emissions? In other words, what do you define as impact? Positive and negative, or positive or negative?
That's very, very interesting discussion. I had the discussion with my team actually on the other side of the materiality. And so first of all, I think on measuring impact of a company. So I have this bottom-up approach. So looking at first companies. So as investor, we have to select in our portfolio companies which actually propose solution towards the challenges, being on the environmental part or being on the social part. That's where I think taxonomy are very important to measure this and to have reliable criteria and KPI to measure what's positive or not, and really measuring percentage of sales of companies being involved in such activities. For me, this is really the first measure. And we have to set target there and increase the portion of companies within our portfolio which have those kind of impact. Because if you focus too much on carbon emission, typically we have a small cap fund which really target solution provider. So it has a strong bias towards industries. So our carbon footprint actually is higher than the carbon footprint of the benchmark, which has more financial and those kind of things. Because on the financial side, scope 3 is never measured, the emission, portfolio emission and so on. So so just focusing on carbon emission of a portfolio, you might really have a sectorial bias. So really focusing on company saving solution. And also, I think, for me, what is very important is the temperature of companies. That's where there is some mess currently because different methodologies, scope 1 or 2, scope 1, 2, 3, what SDA you have, so sector decarbonization approach, really looking at that direction. So it's more forward looking, but still very the beginning, but gives you a more clear pictures of the direction of a company and not its past emission. So yeah, focusing on really, would say, percentage of sales of a company, which really have a positive impact for me is an important measure. Not the only one, of course. Waste, water usage, and so on are very important KPI to look at. But yeah, focusing on solution.
Thank you all so much. I can't believe we're already at the top of the hour. So I just want to thank all of our panelists so much. If we were in a room, we would all be clapping. It was such an interesting conversation. Some of the big things I took away were really this trend that I missed about moving more towards impact. I think that's so crucial. Not letting perfect be the enemy of the good, making these things practical, making them implementable. Working together across different sectors, whether it be with the regulators or public finance, to find ways to drive finance to where it's needed most, and really always come back to this somehow, the need for good data, the need for good information so that we can have strategies that actually lead to the economy and the financial system that we want. So I look forward to continuing these conversations at Building Bridges. Thanks again to our panelists. Please make sure to sign up for the next webinar, which is on September 15th, that will zoom in on social issues. And just so you know, there will be a small survey that will come up. It takes 1 minute just for you to tell us what you thought of this webinar so that we can improve in the future. Thank you so much again, Elodie, Alex, and Vincent, for your time. And thank you all for tuning in. I look forward to seeing you at the next one, and take care. Bye, everyone.
Thank you very much. Bye.
Thank you.
Merci, à
Au
bientôt.
revoir.